Okay, Professor Jim Schultz here from my Finance 513 students. I wanted to go ahead and shoot this video here on the subprime mortgage market that you've been reading about from Chapter 7 and talk a little bit about, kind of everything that happened in 2007 with the housing market collapse. And so let's go ahead and get started. So 2007, what you have to realize at the kind of beginning of this story, so to speak, is that in 2007, the market was booming. The stock market was booming, the economy was booming, everything was growing, everything was prosperous, and so it was all roses and sunshine everywhere you looked, right? And so the economy was really strong, everything was really doing really well. And so from the bank's perspective, from the perspective of the financial institutions, they were basically thinking, all right, we've gotten a lot of people into homes. Is there a way for us to get some more people into more homes? Is there a way for us to kind of keep this thing going a little bit longer so that we can make more profits, so that the economy can continue to grow and flourish, and people can have the quote unquote American dream? And so that's kind of the start, the beginning, the precipice of the subprime mortgage market. Okay, and so here's the basics. So skipping down to the second section, this 228 section, I'm going to start with that second point first. Here's the basics behind a subprime loan, what you have to understand. So a subprime loan, the word subprime actually refers to somebody who has subprime credit, in the sense that their credit may not be that outstanding. And so if you go to a bank and you want a loan for a home, that's typically a huge loan, right? If you want to take out a mortgage, you're talking hundreds of thousands of dollars that you are asking the bank to loan you for the life of the mortgage, which is typically 15, 20, and most commonly 30 years. And so they're going to look at your credit to determine your risk as a borrower, and so to determine if you're credit worthy enough to for the mortgage, right, for the loan. And so most people, when for the history of buying homes and closing on mortgages, most people enter into a fixed rate mortgage. And a fixed rate mortgage is exactly how it sounds. The interest rate that you agree on at the very beginning is going to be the exact same for the life of the mortgage. It's not going to change on you. Okay? So that's where the subprime situation was kind of born. The banks kind of said, all right, maybe we can get some people into homes that honestly wouldn't normally qualify for our traditional mortgage. So here's what we're going to do. We're going to get these people into what is called a 228 loan. And this is just one example of what is called an ARM, or an adjustable rate mortgage. So here's the basic idea. The bank said, all right, Mr. and Mrs. Jones, your credit situation is not strong enough for you to qualify for a fixed rate mortgage. But here's what we can do. We can get you into a home, the home that you want, at a very low interest rate for the first 2 years. Then after the 2 years are up, that loan is going to reset to a higher number for the remainder of the mortgage. Okay? And so the basic idea there is you're going to have a low payment for 2 years, and then the payment is going to jump sometimes substantially in that third year and beyond. Okay? And here's why we, the bank, Mr. and Mrs. Jones, here's why we think this is a good idea. Because it's 2007, right? Up until this point, house prices never went down. Never. They didn't always go up like gangbusters, but they really never went down. They might move sideways for a little while, but everybody basically rested on the assumption that housing prices are going to continue to climb. And in 2007, people were really excited because everything was going so well. They were thinking, well, these house prices are probably going to rise pretty quickly. And so here's the idea. Normally, Mr. and Mrs. Jones would never ever want to sign up for a 228 arm, or any arm for that matter, right? Just based on what I've shared with you guys so far, just based on what we've learned so far, a 228 loan would not make any sense for anyone. But here's the kicker. The kicker is this: the bank would then tell the potential customers, all right, listen, here's what you can do. In 2 years, when your rate is about to reset to a higher number, you can refinance your loan at a fixed rate, and then you can lock in a fixed rate for the remainder of those 28 years. So you will not essentially be, so you're going to essentially get the best of both worlds. You're going to get a low rate for 2 years, and then when the rate is set to adjust, you can refinance at a fixed rate. And basically, for those of you that may not be homeowners yet, when you refinance a loan, basically all you're doing is you're going to the bank and you're saying, hey, I would like to restructure the terms of my mortgage, right? And of course, you would only do that if it's in your best interest. So a lot of times you might do that if you have an adjustable rate mortgage, like this example, and you want to restructure it to a fixed rate mortgage. That might work. Or if you buy a house and take out a mortgage, and then over the course of the first few years or whenever it happens, really, interest rates go down, then you might want to approach the bank for a refinance so that you can refinance or restructure that loan at the prevailing lower interest rate that is now in the marketplace. So that's the basic idea, okay? But here's the kicker. Most banks will not allow you to refinance any mortgage unless you have at least 10% equity in your home, okay? So the kicker was this. The bank is sitting down with Mr. and Mrs. Jones and going over this arm, going over this 228 scenario, going over this, this future refinancing that they think that Mr. and Mrs. Jones will be able to do. In this scenario, simply based on the nature of this being a subprime loan to begin with, keep in mind we're dealing with a subprime mortgage. So we're dealing with borrowers that can't qualify for a traditional mortgage. Normally, one of the reasons why someone would not be able to qualify for a traditional mortgage is they do not have enough cash, they do not have enough liquidity at that time to make any sort of a significant down payment. So many of these individuals were rolling into these 228s with zero down, like nothing down, right? And so they literally walked into these loans with no equity, which means you take out a $200,000 mortgage, you owe $200,000 on that house right away. You have no skin in the game. You have no equity in your house. Okay? So the kicker was this. The banks would say, well, if home prices continue to rise, any price appreciation that you realize on this home becomes instant equity in the house, which is absolutely true. That is true today. That is how that is how buying a house works. If you buy a house for $200,000, right? Like here's a good example for you guys. You buy a house for $200,000. You put $20,000 down, right? So that means that when the loan begins, you have $20,000 equity. You owe the bank the remaining $180 to bring you up to $200, right? Well, let's say 2 years go by and your house price appreciates and it's now worth $220. That additional $20,000 from $200 to $220 is additional equity in the home. That is your money. That is not the bank's money. That's your money because you're the homeowner. So now your own little balance sheet, so to speak, looks like you have a home worth $220,000. $40,000 of that is equity. $180 is the money you owe the bank, right? I'm not including any of the mortgage payments you've made. I'm just trying to make it really simple. But that's the basic idea. So getting back to our ARM example, the bank would say to Mr. and Mrs. Jones, when your home price appreciates, that will be your equity. So in 2 years, when this rate is about to reset, when this 228 is about to reset to that higher rate, you will most likely have realized a price appreciation that will be large enough to allow you to refinance at a fixed rate, right? And so to Mr. and Mrs. Jones, they were thinking, wow, it's 2007, everything is booming, we want to be a part of this, and yeah, let's do this. This sounds terrific, okay? Well, all of a sudden, the unthinkable happened, and house prices did not appreciate. Not only did they not appreciate, but they started to go down. they started to decrease. And so all of a sudden, like literally, it was almost like a game of dominoes. Once a couple dominoes started to fall, it just started to really exacerbate and really deteriorate very, very rapidly. Because you have all these subprime borrowers that are in the marketplace, right? They're all banking on the fact that their home prices are going to appreciate so that they can refinance, because they most of them simply cannot afford the mortgage payments at those higher rates after the ARM resets after 2 years. And so what happened was, not only, so you've got, picture thousands, tens of thousands, hundreds of thousands of people buying homes for $200,000, right? And they're thinking in 2 years these things are going to be worth 220, 225, 230, whatever. They'll refinance at the fixed rates. They'll be all set, no problem. Well, what actually happened was, as time went by, the house price not only did it not go up, it didn't even stay the same. So now these $200,000 houses, their values are dropping to 195, 190, 185, 180. So that's called being underwater on your house. So now, not only do Mr. and Mrs. Jones not realize the price appreciation, but they owe more on their home than it's actually worth. They borrowed the full $200,000 at the beginning, and now they owe the bank $200,000 on a house that's only worth 180. So they have negative equity in that house, and their interest rates are about to reset higher and make their monthly payments higher, which is not a sustainable situation for them. And so this is where the meltdown comes into play. It literally got so bad, and that's why 2007 deteriorated so rapidly. It got so bad that for many people, they did not even care about their credit anymore. It didn't even matter. For most people, the best scenario was literally just leave the keys in the mailbox, call the bank and say, "Come take it. We can't afford this anymore." And so that is essentially what happened. And so this is what made things even worse. So you had home prices starting to deteriorate. So then, that was somewhat manageable, but then you had all these subprime borrowers walking away from their homes. So then what happens? The home then gets foreclosed on, and it essentially becomes repossessed by the bank. So now the bank owns the home. Banks are not in business to own homes. Banks are in business to create mortgages for homeowners like you and me, right? So now banks, they become flooded with a bunch of homes that they don't even want. And so think again about basic economics. Think back to supply and demand, right? What essentially happens? The supply of all these homes starts to increase, and increase at an accelerating rate when more and more subprime borrowers just keep leaving the keys in the mailbox, and they're like, "Hey, we're done. We're walking away from this. We can't afford these payments. We can't do this. It's not sustainable." It didn't play out like you thought it was going to play out. That being Mr. and Mrs. Jones saying back to the bank like, "Hey, you told us we were going to be okay, and we're not okay. So here, take it. Do whatever you want with it," right? And so so things are accelerating quickly. The supply of homes is increasing at an accelerating rate. And so whenever the supply of something goes up, what happens to its price? Its price always comes down. So then not only did you have the beginning of the unthinkable with prices starting to fall, but now all of a sudden prices are just falling and falling and falling and deteriorating very rapidly because the supply of homes was increasing so rapidly. And so that's essentially how the subprime mortgage market fed into the housing market collapse in 2007. And honestly, that's why it was so nasty for 5, 6, 7 years. I mean, it's 2000. It is July 6th, 2014. We are literally still feeling the effects of that housing market collapse in 2007. And so, whose fault was it ultimately? I think it was both parties' fault. I think that it was the bank's fault for being somewhat misleading. I mean, obviously I wasn't there at every transaction. I've only read about what's happened and heard some customers and what they've had to say. I think the banks were somewhat misleading in terms of what they did to try to generate more business. But I don't feel like the customers themselves are completely without fault either. I certainly feel like it was a bit of a mistake on the customers and buyer standpoint. not being better informed, not being better prepared, and not fully understanding what they were getting themselves into. So I feel like both parties were definitely at fault to some degree. But that is essentially how the subprime mortgage market fed into the housing market collapse. And I hope that you guys found that to be useful.